History has a way of disguising its most important moments until they're already behind us. But every once in a while, you can feel the ground shifting before the world catches on. That's what makes September 7th, 2025 so important. It will not just be another date on the calendar. It will mark the moment when silver transitions from being overlooked and undervalued to becoming central in the story of money, trust, and power. Throughout history, the story of silver has been closely tied to the broader cycles of money, power, and trust. If you look carefully at the long arc of human civilization, you'll see that silver has never been merely a commodity. It has been money, a store of value, and a mirror reflecting the strength or weakness of the systems people depend on. Empires rose and fell. Currencies were created and destroyed. Promises were made and broken. And silver was there through it all, serving as a silent witness to the shifts in economic foundations. To understand why September 7th, 2025 may be such a pivotal point for silver, we must first go back and study these repeating patterns. For centuries, silver was central to trade and exchange. Ancient civilizations relied on it not only because it was beautiful or rare, but because it was practical, divisible, durable, and universally accepted. From the Roman denarius to the Spanish pieces of 8 silver carried with it the weight of global commerce. The great empires of the past anchored their currencies to silver because it represented stability, something tangible in a world of uncertainty. Over time, as governments spent more than they earned and promised more than they could deliver, they began to debase their coins, mixing cheaper metals in with silver, hoping no one would notice. History shows us that people always do notice. Eventually, once the trust in money eroded, economies spiraled into inflation, political orders were shaken, and silver's role was reaffirmed as a measure of real value. In the United States, silver played a critical role in the early monetary system. For a long time, silver was a legal foundation of money. But as the financial system evolved, silver was gradually pushed aside. By the late 20th century, the connection between silver and money had been deliberately severed, replaced by faith in paper currencies, backed by nothing but government decree. That shift did not erase silver's importance. It only pushed it underground. Investors and nations with longer memories continued to accumulate it quietly, recognizing that systems based purely on promises are always temporary. The 20th century gives us countless lessons in this regard. In times of war, crisis, or inflation, the demand for silver always surged. It was not just an industrial metal, it was a lifeline. In the inflationary storms of the 1970s, silver's price exploded as people sought refuge from the eroding value of paper money. The Hunt brothers' attempt to corner the silver market during the decade wasn't just an episode of speculation. It was a symptom of a deeper reality. People knew that silver was vastly undervalued compared to its role in the real world. That episode ended in dramatic collapse, but the underlying truth remains: silver cannot be suppressed forever when confidence in the system weakens. The cycles of history always repeat, just in slightly different ways. Today, we find ourselves once again at a critical juncture. Governments around the world are drowning in debt, spending more than they can sustain, and printing money to cover the gaps. Central banks are losing credibility, and people are questioning the long-term stability of the currencies they once trusted. At the same time, geopolitical tensions are reshaping global trade, aid, and finance. Just as the Roman Empire, the Spanish Empire, and the British Empire experienced the consequences of overreach and monetary debasement, the modern financial system is facing the same strains. When confidence begins to waver, people instinctively return to what is real, what is scarce, and what cannot be manufactured out of thin air. Silver sits at the heart of this shift. It is not only money, it is also an industrial necessity. In a world that is rapidly electrifying and transitioning to new technologies, silver's role extends far beyond wealth preservation. It powers solar panels, electronics, and medical instruments. Unlike centuries past, when silver was primarily money, today it holds a dual role that makes its scarcity even more pressing. Despite its critical importance, the market for silver remains tiny compared to the vast flows of global capital. This mismatch between silver's real world necessity and its current valuation is precisely why turning points occur. If you study history carefully, you will see that markets always sleep until they are forced awake. Silver has been in that slumber for decades, overshadowed by gold and financial innovations. But history shows that when monetary systems reach their limits, the metals that cannot be printed come back into focus. September 7th, 2025 may be remembered as one of those moments when the pressures that have been building beneath the surface finally break into the open. It will not be the first time silver has played this role, and it will not be the last. The lesson is clear. Silver's history is not just about price charts or market cycles. It is about the enduring struggle between promises made on paper and value that stands the test of time. The world we are living in right now is shaped by forces that have been building for decades, converging in ways most people don't fully recognize. Silver sits at the intersection of those forces. To understand why the coming period, and particularly the months leading into September 2025, will matter so much, you have to step back and look at the big picture. You can't just focus on silver as a commodity. You have to see it as part of a much larger system where debt, money, power, and psychology all come together. The first force is debt. Around the world, governments, corporations, and households have accumulated historic levels of debt. For decades, the global economy has been propped up by borrowing more and more to finance growth, cover deficits, and delay painful choices. This was sustainable as long as interest rates kept falling, making that debt easier to service. But the cycle of falling rates has ended. Debt burdens are now colliding with higher interest costs, and that combination is unsustainable. History tells us what happens when debt levels grow beyond the ability to pay. Either it gets restructured or it gets inflated away. In both cases, real assets like silver gain importance because they cannot be devalued by the stroke of a policymaker's pen. The second force is inflation. Despite the rhetoric that inflation is under control, the reality is that the structural drivers of higher prices remain in place. Aging populations to globalization, energy transitions, and massive government spending all contribute to inflationary pressures that are not temporary. Central banks can raise interest rates to fight inflation, but doing so makes the debt problem worse. They can lower rates to ease the debt burden, but that fuels more inflation. This is the trap. When paper money loses its reliability, people instinctively look for stores of value outside of the system. Gold has always been the first refuge, but silver, being more accessible and more volatile, often sees the sharpest repricing once investors realize the system is cornered. The third force is the shift in global power. The world order built after World War II, with the US dollar at the center, is being challenged in real time. Rising powers are seeking alternatives to the dollar-dominated system, forming new alliances, trading in local currencies, and quietly building reserves outside the traditional structures. This is not happening overnight, but it is accelerating as trust in the dollar weakens. The appeal of tangible assets grows stronger. Silver, with its history as money and its modern industrial demand, stands to benefit from this transition. When power shifts, money follows. And when money shifts, the assets tied to real value reprice dramatically. The fourth force is supply and demand imbalance. Unlike fiat currencies, silver cannot be created at will. It must be mined, refined, and delivered, and the supply is finite. At the same time, demand for silver is being driven not only by investors, but by industry. The global push toward electrification, renewable energy, and advanced technologies requires more silver than the current mining infrastructure can provide. This dual demand as money and as an industrial necessity makes silver uniquely positioned in a way that gold is not. Gold is hoarded, silver is consumed. That reality creates pressure points that can build quietly for years and then erupt suddenly when investors and industries are forced to compete for scarce supply. The fifth force is confidence, or more accurately, the loss of it. The financial system runs on trust that governments will manage responsibly, trust that central banks will preserve the value of money, trust that markets are fair and functional. But trust is fragile. Once cracks begin to show, they spread quickly. We are already seeing signs of this erosion. Savers feel their money buys less. Investors question the sustainability of the system. Nations hedge against the dollar. When confidence breaks down, the shift toward hard assets accelerates. Silver is small relative to global capital markets, which means even a modest reallocation of wealth into silver can have an outsized impact on its price. All of these forces are converging now, not in isolation, but together, amplifying one another. High debt makes inflation harder to control. Inflation makes debt harder to sustain. Geopolitical realignment undermines confidence in the existing order. Supply shortages intensify as demand rises from both investors and industry. Confidence in paper promises weakens, driving people toward what they can hold. This is how turning points emerge, not from a single event, but from the cumulative pressure of forces that can no longer be contained. By the time September 2025 arrives, these forces will not have disappeared. They will be more visible. The imbalance between paper assets and real assets will be harder to ignore. Policymakers will continue to try to buy time, but time is no longer on their side. When the convergence of these economic forces reaches its breaking point, silver will not simply rise in price. It will be revalued in the minds of people and nations as something essential once again. That is how history moves forward. And that is why the coming period represents far more than another chapter in the market cycle. Human behavior has always been the most powerful force in markets. You can study the numbers, the charts, the policies, but at the end of the day, it comes down to how people think and how they act when the pressure builds. Silver, like all assets tied to money and trust, goes through long periods of neglect followed by sudden surges of attention. These are not random swings. They are the natural result of psychological thresholds being crossed, points at which the crowd shifts from complacency to urgency, from doubt to belief, from ignoring an asset to chasing it. Understanding these shifts is critical to understanding why silver is approaching a turning point. For years, silver has been ignored. Investors saw little reason to hold it because the broader system appeared stable. Stocks rose, bonds offered returns, and central banks seemed in control. Silver was seen as old-fashioned, a relic for survivalists and contrarians. That complacency was a psychological state, a belief that paper money was safe, that inflation was under control, and that the system would always function smoothly. But psychology is fragile. It holds until a few key assumptions are tested, and then it unravels quickly. The first threshold people cross is the recognition that money is losing value faster than they expected. Inflation does this. When wages don't keep up with prices, when savings buy less each year, people begin to question what they once took for granted. They might not immediately rush to buy silver or gold, but the seed of doubt is planted over time. As they see their cash losing purchasing power, they start to look for alternatives. At first, it might be real estate, stocks, or other tangible assets. But eventually, when confidence in paper itself weakens, silver comes back into view. The second threshold comes when investors realize the system is not as trustworthy as they assumed. Manipulation of interest rates, massive expansions of central bank balance sheets, and policies designed to paper over structural problems all create unease. For a long time, people tolerate it because the consequences are not immediately visible. But history shows that once enough people sense the gap between what is being promised and what is sustainable, the herd mentality shifts. Suddenly, what was dismissed as paranoid thinking becomes mainstream caution. In that moment, silver is no longer seen as eccentric. It becomes practical. The third threshold is fear of missing out. Markets always move in waves. When silver begins to rise slowly at first, most people remain skeptical. They dismiss it as noise. But as the price builds momentum, psychology flips. The same investors who ignored silver at lower levels begin to chase it at higher ones. This is the herd instinct. They don't want to be left behind. They see headlines, hear conversations, and watch others profit. And their skepticism turns into urgency. This stage has repeated itself throughout history, whether in the 1970s bull market or the brief spikes in the 2000s when psychology reaches this threshold. Silver's moves are amplified because the market is so small compared to global capital. A relatively modest wave of new buyers can create dramatic price swings. The fourth threshold is panic. This comes when people realize not just that silver is rising, but that they may not be able to get it at all. Paper silver markets built on contracts and leverage give the illusion of abundance. But when investors demand physical delivery, the limitations of supply become obvious. Fear of shortage is a powerful psychological force. It shifts behavior from speculation to desperation. In these moments, silver is no longer just another investment. It becomes insurance, something people feel they must secure at any cost. What makes these psychological thresholds so important is that they don't move in a straight line. They build slowly, often invisibly, and then break suddenly. One day, the majority dismiss silver as irrelevant. The next day, they can't stop talking about it. This is how human psychology works. It clings to old beliefs until the evidence against them becomes overwhelming, and then it rushes to embrace the new reality. We are now in the early stages of this transition. Doubts about inflation, debt, and monetary stability are spreading. People are beginning to question whether the old assumptions about safety and stability are still valid. At first, this manifests as quiet buying, small shifts in allocation. But as more investors and eventually institutions cross those thresholds, the shift accelerates. By the time the broader public recognizes what is happening, silver will already have repriced significantly higher. The lesson of history is clear. Markets are moved less by fundamentals alone than by how people perceive those fundamentals. Silver doesn't need every person on earth to buy it. It only needs enough people to cross those psychological thresholds. Once they do, the dynamic changes from apathy to urgency, from skepticism to conviction. September 2025 may very well mark the point when enough of those thresholds are crossed to trigger the kind of repricing that only happens a few times in a century. And when it happens, it won't feel gradual. It will feel sudden because psychology always shifts gradually and then all at once. Every system, no matter how strong it looks on the surface, has breaking points. You can build rules, policies, and mechanisms to delay those breaks, but you cannot eliminate them. History shows that when debt becomes unmanageable, when money loses credibility, when power structures shift, the system reaches a stage where incremental adjustments are no longer enough. That is the systemic breakpoint. And it always comes with a mix of denial, surprise, and rapid change. Silver's role in this moment is not accidental. It represents something the system cannot print, cannot manipulate endlessly, and cannot replace once confidence is shaken. For decades, the global financial system has been stretched to accommodate excesses. Governments borrowed more than they could afford. Central banks created money in quantities that would have been unthinkable in the past, and investors placed blind faith in assets that relied entirely on promises. The system functioned because the costs of these actions were not immediately visible. Low interest rates made debt appear manageable. Expanding credit kept economies growing. Rising asset prices convinced people that everything was sustainable. But under the surface, imbalances grew. The debts were real. The promises piled up, and the ability to deliver on them diminished. A systemic breakpoint occurs when those imbalances can no longer be hidden. It may come from a spark, a geopolitical shock, a financial crisis, or a sudden loss of confidence. But the cause is deeper. It comes from years of stretching the system beyond its natural limits. By September 2025, the world will likely be facing exactly that reality. Rising interest costs will make debt harder to sustain. Inflationary pressures will force choices that have no easy solutions. Attempts to stabilize one part of the system will destabilize another. That is when the cracks become undeniable. In those moments, people stop asking whether the system is sound and start asking how they can protect themselves from its failure. This shift in mindset is profound. It leads to behavior that accelerates the very crisis people fear. Banks see depositors withdraw funds. investors dump risky assets. Nations look for alternatives to the reserve currency. Trust unravels quickly because trust, once broken, cannot be restored with words alone. It must be rebuilt with credibility, and credibility takes time. The system no longer has time. Silver becomes central in this kind of environment because it operates outside the fragile architecture of promises. It cannot be printed to solve a debt problem. It cannot be devalued to inflate away liabilities. It exists in finite supply, tied to the real economy through industrial demand, and tied to human psychology as a form of money that has endured for thousands of years. When a systemic breakpoint occurs, silver shifts from being a speculative trade to being a necessity. It becomes not only an asset to hold, but also a statement of independence from a failing system. Think back to past moments of systemic stress. In the 1930s, when the global financial order fractured, gold and silver reasserted themselves as anchors. In the 1970s, when inflation spiraled and currencies lost credibility, investors fled into tangible assets. In emerging markets facing crisis after crisis, the population instinctively returned to metals and goods they could trust. Each time, the details were different, but the pattern was the same. Promises broke, confidence collapsed, and real assets rose to fill the void. The coming breakpoint is global in scale. Unlike past crises that were regional or contained, the excesses of today are embedded everywhere. Debt levels are high across developed and emerging economies. Inflation is a worldwide challenge. Geopolitical competition ensures that cooperation will be limited. This means the next systemic adjustment will not be a small recalibration. It will be a reset of assumptions about money, value, and stability. Silver, though often overshadowed by gold, has a unique position in that reset. It is smaller, more volatile, and more constrained in supply, which makes its repricing more dramatic once demand shifts. The critical point is that systemic breakpoints do not unfold slowly. They build gradually and then appear suddenly, catching the majority by surprise. Most people believe the system will hold until the very moment it does not. That is why silver's role is so misunderstood. By the time the average investor realizes the system is at a breaking point, silver will already have moved significantly. The opportunity exists in seeing the patterns before the crowd does, in recognizing that the forces pushing the system toward its limits are not temporary fluctuations, but structural realities. As September 2025 approaches, the convergence of debt burdens, inflationary pressures, geopolitical shifts, and supply-demand imbalances points to a moment when the financial architecture we rely on will be tested in ways not seen in generations. That will be the systemic breakpoint. And when it comes, the world will rediscover what it forgot, that real value is not created by promises, but by scarcity, utility, and trust built over centuries. Silver embodies all three, which is why it stands to play such a critical role in what lies ahead. When you think about what lies ahead, the implications are not only about where the price of silver goes, they are about what the turning point represents for the broader financial and social system. Every major shift in markets is also a shift in behavior, in priorities, and in how people define security. Silver, in this context, is more than a metal. It becomes a signal, a reflection of deeper changes in how the world is functioning, and a guide to how individuals, institutions, and nations will respond to the pressures building around them. One of the most immediate implications is a reordering of portfolios and strategies. For decades, traditional financial assets, stocks, bonds, real estate dominated the thinking of investors. The assumption was that these assets would always provide growth or stability because the system itself was stable. But as confidence erodes, those assumptions weaken. A small reallocation of capital into silver can have outsized effects because the market is so small compared to global finance. That means when investors begin to move even a fraction of their wealth into silver, the repricing will be sharp and sudden. The recognition of silver as a strategic asset will spread quickly once this shift begins, and it will force investors to think differently about diversification. Another implication is geopolitical. Nations that have relied on the dollar system will continue looking for alternatives, And in doing so, they will not limit themselves to a currency alone. They will also turn to assets that carry no counterparty risk. Gold has long been the favored reserve, but silver's dual role as money and industrial necessity makes it increasingly relevant. Sovereign wealth funds and central banks, which have historically overlooked silver, may reconsider its value in a world where supply shortages collide with monetary instability. The actions of these large players will amplify the shifts already underway in individual behavior. For industries, the implications are equally significant. Silver is not just a monetary hedge. It is also a critical input in the technologies driving the future solar panels, electric vehicles, advanced electronics, and medical applications. As demand from investors rises at the same time industrial demand accelerates, supply will become a defining issue. This will create competition between industry and investors for the same scarce resource. Companies that rely on silver will face higher costs, and in some cases, shortages that will ripple through supply chains, affecting energy, technology, and healthcare. What was once a quiet commodity market will suddenly be a strategic concern at the highest levels of business and government. The implications also extend to psychology. Once silver is revalued in the eyes of the public, it changes the way people think about money and security. A generation that has grown up trusting digital balances and paper promises will be reminded that wealth tied to something real cannot be erased or inflated away as easily. This shift in mindset has far-reaching effects. It alters saving patterns, investment strategies, and even political pressures as populations demand more accountability from leaders who have relied on monetary manipulation to cover structural problems. The rediscovery of silver's role is, in essence, the rediscovery of discipline in a world that has relied too heavily on shortcuts. There is also an implication for timing. By the time the world recognizes silver's importance, much of the move will have already occurred. That is how turning points work. They reward those who act early, not those who follow the crowd. History shows that markets do not gradually adjust to new realities. They overshoot, driven by fear and urgency, once the shift becomes obvious. This means that the real opportunity lies not in reacting to headlines, but in anticipating the pressures that are building. Those who wait for confirmation will find themselves buying into a market that is already transformed. Looking further ahead, the repricing of silver may also contribute to broader discussions about the future of money. As trust in fiat currencies weakens, alternatives will be considered, ranging from digital assets to commodity-backed systems. Silver, with its deep history and practical utility, could play a role in those discussions. While it is unlikely to replace currencies outright, it will increasingly be seen as a parallel form of security, one that sits outside the control of governments and central banks. In that sense, the implications go beyond economics. They touch on sovereignty, independence, and the balance of power between individuals and institutions. Ultimately, the most important implication is about resilience. In a world where systems are under strain, where debt and inflation are colliding, and where geopolitical tensions are reshaping the global order, resilience will come from holding assets that cannot be undermined by policy choices or broken promises. Silver offers that. It is not a perfect solution, but it is a critical piece of the puzzle for those who want to protect themselves in uncertain times. So as we look ahead, the question is not simply whether silver will go higher. The deeper question is what that rise represents. It represents the breaking of illusions, the shift from paper promises to tangible value, and the rebalancing of a system that has been stretched too far. The turning point for silver is, in reality, a turning point for how we think about money, wealth, and security in the decades to come. When the history books look back, they will say that September 7th, 2025 was not just a turning point for silver, but a turning point for the way people think about money itself. The question is not whether this change is coming. The real question is, will you recognize it before the crowd does, or only after it's too late?